worth, right? Whoever sells it. Wrong. I'm Charlie. Welcome to Moving Home with Charlie, and thank you for coming.
Charlie Lamdin grew up in Sussex, is the founder of Best Agent and presenter of Moving Home with Charlie.
If you want to find one of these guys, look out for those compassionate professionals. All estate agents are not the same.
So Charlie, what would be your advice for people interested in buying new builds right now?
Don't overpay. Do buy, but don't overpay. That's why I say disregard the guff. Read into the numbers and look, and it's buried. The bad news is buried in the small print, okay?
Good evening, everyone. Welcome to the Property Press Awards.
They may or may not be telling the truth, but you should form your own view. Get out and view, get out and view, get out and view. You cannot be in a position to make offers and have the offers accepted if you're not viewing. Just be out there viewing. Pay attention to the back of the class. If you've not been watching my videos, I did one just a couple of days ago. Disregard the guff, guys. Good evening, everybody. My name is Charlie Lamdin, and this is Moving Home with Charlie. And this evening, we're having a very special conversation with Richard Donnell, who is the Director of Research from Zoopla. For the benefit of all of you who are new followers here, and there are a lot of you in the last couple of weeks, I wanted to just recap my background, then introduce Richard's background, and we will, of course, have Housing Stig, also known as Alex Groundwater, as a contributor to the discussion. Someone said, is Alex on your side? And I said, Alex isn't on anyone's side. He solely seeks the truth. And he will disagree with me as strong as he disagrees with anyone if he disagrees. I'm wearing my Guns N' Roses t-shirt tonight to remind me that I've actually got to end on time this evening because I've got to travel to London. I'm seeing Guns N' Roses in London tomorrow, which I'm very excited about. But really quick recap. What the hell do I know about the housing market and house prices? My roughly 30-year working life started out with 3 years in the city as a derivatives broker for a large house. And I got to trade and get involved in trading almost every single financial commodity that there is, and derivatives, futures, options, foreign exchange, the whole lot. And it was like a 3-year boiling pot boot camp of learning about the money markets, the financial markets, and how they work. And I had no idea how valuable that brief until I was fired at the age of 21. Anyway, I then moved on, and after a couple of other things, including car washing, actually, for a while, I got into the provision of software and marketing products to estate agents, first of all in London, then in Sydney, Australia. And I believe I'm correct in saying that I'm the only person who has conceived, designed, overseen the building of, launched to the market and sold 3 estate agency CRM systems from scratch to the market. And in that 20 years, I've had clients of all sizes in estate agency, residential estate agency, using it. And what I've realized now in the last year is that spending all of my working life inside the information in those CRM systems, which are the databases of buyers and sellers and landlords and tenants and properties and everything, uploading the properties to Rightmove and Zoopla on the market and the agent's website. I have been bathing in property data in one way or another for over 20 years, much as my guest Richard has, but in a slightly different way. And so I am not someone who pores over spreadsheets and graphs, which I think both Richard, and he'll correct me if I'm wrong, but Richard and certainly Alex, Alex Stig does it for fun, okay, but I have developed what I would say is a keen instinct, and I've also got better and better at eliminating or trying to minimizing confirmation bias, okay? Now, I'm going to go back to September 2021, when I said to my colleague Samantha, who is in the live chat here tonight, she's moderating, by the way, so if you're naughty, she's going to kick you out. And the rules are, say anything you like, as long as it's not personal. You can say anything you like about the topics, about the points, no personal remarks, instantly blocked, okay? Samantha's there, ready to block anyone who's really rude. And I said to Samantha in September 2021, when she moved out of the house that she bought a few years earlier, in with her boyfriend, I said, what are you going to do with your house? She said, I don't know, I might sell it, might rent it. Her house was in Taunton. It was a 3-bed semi in a very nice place on the side of a canal in Taunton. And there is actually a documentary about this, what I'm about to describe. And I said to her, and this is September 2021, okay, so not far off 2 years, 21 months ago, 20 months ago, nearly 2 years ago. And I said to her, the housing market is going to turn in 2022. And I just had this sort of feeling. And I said, so, you know, if you think about selling it, now would be the time. Start before everyone else does. In a few months later, and Sam did sell it, and she sold it at the very, very top of the market. And it's a fascinating documentary. Watch it. It's called Seller Secretly Films 11 Estate Agents. And it's great. If you haven't seen it, go and see it. Just look it up on my YouTube channel. In February 2022, so almost 18, or not quite 18 months ago, I put out a video on this channel, which is actually the welcome video on the channel page on YouTube, where I said for the first time, and I'd been thinking for a while, but it was the first time I felt confident enough to say it, that I thought that I had just begun to witness the conditions that might lead to a turn in the property market. Now, I had seen them. I had seen, it's like a firework going off, and then the firework runs out of its puff and goes, and I just saw that happening in February at the coalface. I could see it in the data. I could see it in the best agent data and CRM stuff, and talking to agents. It was like, ooh, something's changed. And then in May, I was certain of it. And I saw what's happening with interest rates. And I came out and said, house prices are going to fall significantly. And then in August, at which point I thought it was obvious to everyone in the industry. I genuinely did. I put out a video on this channel called 8 Reasons UK House Prices Will Collapse, which went viral and was the beginning of this channel in many ways. And here we are 9 months later since that video, and things are playing out how I wanted, not how I wanted. It was a Freudian slip. Not how I wanted. I mean, of course, I'm happy to be exonerated to a degree, although we still don't know yet because of the delay. But this is the point I want to lead up to, and I'll discuss this at length with Richard, okay? If there is one thing that I am certain of when it comes to national average house prices, it is this. And I will argue this point with anybody. We do not begin to find out what is happening at the coalface of transactions being agreed today in estate agents' offices up and down the country for at least 9 months. I won't waste time explaining why right now. I might explain more when we get the discussion with Richard, but it is at least 9 months. And what I mean by that is when the land registry data first comes out, as some came out today, it is showing us what was beginning to happen because their sample is tiny, as Housing Stig will point out to us. We've seen a very small sample of what was happening at the coalface last September, right? Before the mini budget happened. The mini budget happened at the end of September last year, okay? And Nationwide and Halifax, who have a much smaller time lag, they started showing price falls in autumn last year, late autumn last year, didn't they? And so did the land registry. And so what I'm saying is that those price falls were reflecting things that had actually happened in Q2 2022. Okay, so over just about a year ago, just over a year ago. And we're just seeing it now. It is at least 9 months, if not more. And that time lag is the most bewildering, confusing, and befuddling thing for people trying to figure out what's happening today. And the truth is, nobody knows what's happening today at the coalface, except in hyper-local markets where you get out and actually put your finger on the pulse, talk to agents, view properties, and find out. That's the only way of knowing what's happening at the coalface. Okay? So I said last autumn that, in my view, house prices were going to fall peak to trough over however long that took, 35%. And this is a ballpark figure. There's no spreadsheets involved, no accurate calculations. This is a gut feel ballpark figure, which I stand by as strongly as ever to this day. Now, that's 35% nominal, so that's not including inflation. If you include inflation, it would make it bigger. And Richard, who has today or yesterday put out the Zoopla House Price Index, expecting 5% fall, nominal falls during the 2023, I think, and I'll allow him the opportunity to clarify. So this discussion is Richard's 5% nominal versus my 35% nominal. And to see whether or not we have any overlap on the data we're looking at, and to see where we disagree and why, and to discuss the reasons with each other. So I've been babbling for 10 minutes. I will stop babbling now. And I will welcome Richard. Where are you? There you are, Richard. Good evening and welcome. And thank you very, very much for coming on the show this evening.
Thanks. Into the lion's den. Looking forward to it.
Into the snake pit of home buyers and sellers and movers. Absolutely. And as Steve Stone in the comments says, 2 falls or a knockout to decide the winner. No biting, scratching or kicking.
Absolutely.
But evening, Alex, you're there as well.
Hello, Charlie. Hello, Richard.
So, Richard, am I correct? So you started your career at Savills in research, and then you went to Home Track.
Yeah.
And you were at Home Track when Home Track was acquired by Zoopla in 2019.
Yeah.
And at which point you became what you do now, which is what would you say your title is?
Well, I'm research director. I mean, I've been all my whole career a housing market analyst doing strategy, consulting, advisory for businesses operating in housing, government. And then with the Zoopla hat on, you've got to speak to consumers basically and sort of help them work their way through. But I mean, everyone's housing experience is whether a renter or a buyer, where they live. I mean, the housing market is not one single thing, is it?
No, exactly. It is a massive, massive melting pot. So, allow me to begin with the following question. Rightmove's index is asking prices of the most recent month's new listings only. Agreed?
Yeah.
The land registry is accurate completion prices as recorded by the conveyancers at the land registry at whatever time they get around to actually updating it. So yes, agreed. Yep. Nationwide and Halifax are mortgage approval. So that's where they've made a mortgage offer. So they know the agreed price of the transaction, but it is subject to fall throughs and people backing out. And also they both have some kind of funky adjustments that go on that I don't really understand. They both have a similar sample size of around 10, 12%, but they exclude cash transactions. And where those are slightly more helpful than the land registry, for example, is that they are much closer to the transaction agreement point. Now, what I do not understand is how the Zoopla house price index is calculated, because it's not asking prices, it's not completion prices, it's not mortgage prices. So you begin by telling us what it actually is.
No, absolutely. I built it with a load of data scientist colleagues in 2014. We built it. I think there's two methodologies.
The Home Track thing.
Yeah, we built it in Home Track. And so the Zoopla house price index is actually powered by Home Track, who are a data and analytics and valuation business. Home Track do a lot of valuations to banks with an automated valuation model. So we built it in 2014. The inputs are mortgage valuations by human surveyors, so surveyor valuations of what a property is worth. We do use land registry, but the lag on that has got quite bad. And then we use sole subject contract prices on Zoopla, basically. Now, we don't know what the agreed price is, so we apply a localized haircut because we know what the asking to achieved is. So we take where a property's gone sole subject contract, we haircut the price by the national average. And we do something slightly different. So the government index, the ONS, Halifax and Nationwide, and again, you said speak plain English, they all run things called a hedonic house price index, where they take their sample and they deconstruct 1-bed flats, 2-bed flats, 3-bed houses, and they try and sort of work out the price of a standardized house over time. Whereas we take what are called pairs. So we take, a 3-bed house in SE5 8ST has just sold, and we know that another 3-bed house sold 4 years ago or 10 years ago, and we join up all these millions of pairs and we run a regression through it. And so we do what's called a matched pairs or a repeat sales index, which is the other kind of big methodology. It's just a huge regression. And the other thing, I think what I really learned from building a house price index, because we build a house price index to try and be more accurate than everyone else's. A lot of it's about how you weight it as well. Weighting an index is really important. So we tend to weight to the whole stock of housing in the UK. So our index is less volatile than other people's. It's more stable. It moves more steadily. It's not going to be as responsive as the Halifax or the Nationwide. And again, I don't know if those guys include remortgage valuations and things. Is it all home purchase? It's not clear. So yeah, our index is basically a repeat sales methodology. It's got a very big sample size of data going in. It is subject to some revisions because we have the land reg lag, and it's slow moving basically. I think as a business, because we've got a lot of access to very leading edge data, we have 50 million people using Zoopla every month. We have 1 million properties for sale and for rent. So we sort of supplement our house price index report with a far more kind of leading edge data. So some of the data in the report that you're going to talk about that came out this week was up until last Sunday. So, we're trying to sort of we're trying to complement sort of house price data, which is typically backward looking. As you say, once you agree a sale, it takes 3 to 4 months to get through. And so house price indices by their nature are actually a bit rear view mirror.
Yep.
Whereas so we're interested in using the data we've got access to look a little bit more sort of what's actually happening now, as you say, in those estate agency offices to sort of, is this all kind of going to go pear-shaped quickly, or is it sort of going to fizzle, or is it, where's it going basically?
Thank you. So two observations. So you say a large sample size. Do you want to put a percentage figure on that?
I think it's getting on for about sort of 50,000 a month or something. I mean, there's about 90,000, sort of 80,000 transactions a month. I mean, it's not less than 10,000. I mean, it's sort of 40 to 50,000, I think, data points.
Yeah, that's pretty good. That's pretty good.
Not recently, obviously.
No, over time, I think. I can't remember the latest land reg numbers or the latest HMRC numbers. And again, you got to remember, just to be clear, we are using remortgage valuations where a human has turned up and valued a property for remortgaging, as well as the surveyor turning up to do a purchase. So our view is any sort of independent verification of price, we should be using that. So again, just to be clear, we use remortgage valuations where a surveyor's been, as well as purchase cases.
Okay, that's cool. I didn't know. That's interesting. Yeah. Okay. Okay, well, just for the sake of balance as well, we've got Rightmove and Zoopla and the land registry and Nationwide Halifax. The best agent data set, very simple though it is simply, there's no timing, it's a snapshot of all publicly listed homes for sale with garages and chip shops stripped out. And incomplete developments. It's just available homes for sale, and it's 100% of the market to sell to let asking prices, and we have an average and we have a median of both unsold and SSTC. So that's there's no waiting, there's no seasonal adjustment. It's just that's the market today, and to my knowledge, there's nothing that comes close to that. It is very, very simple. We're still working on it. It's a lot of data. It's like having a tiger by the tail. It's feisty data. But I'm hoping, because it kind of fills a spot that nothing else there. But so would you say, and also, yeah, so you're saying 2014 was when you designed it. And actually you designed it, you headed up. So you are the godfather of the Zoopla house price index.
Sadly, yes. But I did it with a data scientist or two. So
okay, that's cool. But you did it in 2014. So your methodology has not yet been tested by a downturn.
Oh, well, we ran the data back to 1995.
Oh, okay.
Charlie, we designed it. What we want to do is design an index that sort of over time, it sort of tracks reality.
Yes.
So again, this is a bit technical, but you can test house price indices, and maybe it's we come back in 3 months and you can run tests on house price indices. You take the land registry data, you take pairs of transactions of the same property, and you get every index to see how good it is at predicting the second price point.
I bet you were as irritated, Richard, as I was when you couldn't go back to 89 in order to get it. You just, it's like, oh, for God's sake, you've got the data, just hand it over, then we could really test it.
But you can test house price indices and see whether they're overvaluing effectively, overstating the market, understating the market. It is possible to test these things, but I think having built one and run one, it's a bit of a I think you're trying to build one as well, Charlie and Stig. So it's not easy, and good luck to you, because it's everyone's experience of the housing market differs around the country. So I think they're far from exact things, because the housing market, as we all know, is far from homogeneous.
Exactly, as you said, it's not a market, it's many, many markets, and it's an awful lot of data, and there's always going to be, if not guesswork, at least a margin for error on any house price index. It's just looking at the ones now and then comparing them at a later date with land registry. And I've not Zoopla because I haven't done that. Some are a little optimistic, shall we say?
No, I mean, just on, yeah, I agree. And look at, there was about 7-8 years ago, the Halifax had a massive negative bias on it, huge negative bias. And when they then sort of handed it over to another company to run it, they sort of wrote back all the negative bias. And so I think it's and look, there's nothing wrong with this stuff. It's just, but I think the people and there was two academics called Fleming and Nellis who designed indices, and they say in their own notes you shouldn't look at them month to month, but PR teams love a good story, and volatility is good.
Exactly. The media pick up on it, and suddenly very few members of the public actually understand what they're looking at and think what they're looking at is the unvarnished truth. And that is a long way from the case.
Yeah. So my next question, Richard, then is, and then we'll get into talking about different reasons for where we see things heading. If you would humor me in terms of there are the three A's of house prices, which are asking, agreed, and actual. How would you say the Zoopla House Price Index fits into that definition? Are you saying it's as close as possible to agreed prices today, or are you saying it sort of spans it all a little bit? And is it covering a month, or is it more likely to sort of a quarter?
No, I think it's we want to track actual values, because a house price index is supposed to talk about the value of all housing, basically. So you want an index that has what's called zero bias, as in it sort of effectively it performs in line with agreed pricing, basically. I mean, the best index is the best indication of achieved pricing over time.
Right.
And so that's what we're all aiming for. So I think we're definitely more in the agreed, in the sort of agreed to achieved end rather than asking, because asking can differ. And I think, there's quite a difference between sort of what people list homes for versus then what they sell for. And so you don't want to be bringing asking prices into the equation too much.
Well, I agree on that. We definitely agree.
Absolutely.
Okay. So I think, as you know, some people watching this will know, in Rightmove's most recent index, they said that they're expecting a 2% fall in asking prices by the end of this year. And I'm assuming they mean in their new monthly listings index, which is just a tiny sample. You're saying 5%. Now, am I right? I want to get the timing. I want to understand the timing. So you're saying that from January to December, for the calendar year of 2023, the prices being agreed in December 2023 will be about 5% lower than the prices being agreed in January 2023.
Correct.
Okay, so so just to make sure we're apples and pears, you're talking about a 12-month period. My 35% is over an estimated, purely guessed, 3-year period. Okay, so did the Zoopla index show any falls last calendar year?
It basically, I put the chart in our latest report, but I think over the course of December through to sort of March, we registered quarterly price falls. And then because mortgage rates fell towards 4% earlier this year, over the spring, we saw a bit of firming. So our index went slightly positive quarter on quarter, but we think that's going to sort of go negative again. So yes, we've seen we basically saw a price adjustment down or a price fall down, but it's not big. Yeah. Basically between Q4 last year and the end of Q1 this year. And again, in our report, there's a chart with the quarter on quarter falls. And then, it just looks like they're going to increase later this year, basically.
Yeah, I've actually got that. I've got that chart right here. I can put it up so people can see what you're referring to. Is that the one?
Yeah. So you can see and these are quarterly changes. We could do monthly. I mean, again, on the basis that house price indices don't tell you a lot month on month. I mean, the quarter on quarter. And again, we also left in here the whole what happened in the global financial crisis just for context. But so we saw a few falls there. I mean, our quarter on quarter, we've seen a slightly positive increase because, again, we have seen an increase in sales in the first quarter of this year as mortgage rates fell. I think we're going to see the price falls open up again I'm sure we'll come on to it, but there's a whole load of reasons for this that I'm sure we'll talk about different assumptions that sit behind this. But this just gives you an indication of how you get towards sort of 5%, basically.
Okay.
Again,
and you're showing there that you think that the falls stop at the end of the year. The year-on-year line starts to turn, and the quarterly one starts to turn. So what makes you think there's going to be a recovery in prices before the end of this year?
Well, I think to stand back a minute, Charlie, and you and I talked about this. I think I might appear optimistic and sort of light on the downturn now, but I also believe that house price growth in this country is going to be much, much lower for longer, for a whole load of sort of structural and various reasons. I just don't think we're going to have much house price growth at all, probably for the next 3 to 5 years. And so, if you're big down were to sort of rebound up, who knows? We might meet in the same place in 5 or 6 years' time. Do you know what I mean? So I think,
unfortunately, we both of us believed, like you, that they will stagnate. It's just at what level they'll stagnate.
Exactly. So I think, that's I haven't, again we can get into the detail on this, but I think that the trouble we've got at the moment, the big thing that's supporting the housing market for me at the moment is two things really. One is forbearance from lenders, which is total different change in approach to where they were. And I think the strength of the labour market. I think if the labour market were to really weaken and unemployment were to rise, then you'd be sort of marking down prices more aggressively, basically. And so a lot hinges on this very strong labour market we have. And again, I've just looked at some numbers. There's the economists out there, and again, you can believe economists or take what they say with a pinch of salt, but there's not a massive increase in unemployment forecast. So I think for me, that supports prices, reduces forced sellers, and so you don't get that big adjustment. But I do think we're going to have a prolonged period of very weak growth where house prices realign with incomes. And so it's sort of akin to, again, I give you two examples. I mean, if you take Aberdeen, in Aberdeen, our index in March 2015 to date was 25% fall in nominal terms in Aberdeen, because the oil price peaked, it crashed. Aberdeen's like a one economy town, which is oil and gas investment in the North Sea. So basically, house prices in Aberdeen in nominal terms are down 25% since 2015. And that's over 8 years. And again, Labour don't want to give gas licenses and oil exploration licenses. And so that's an example of how an economy can really hit a housing market. And the other one I quote often is the market for flats in London. I mean, London was really overvalued in 2016, just as the Brexit vote landed. Had really strong house price growth. And so the value of a flat in London, and half of London is flat, has not increased in nominal terms since 2016. And so it's gone sideways and down 24% in real terms in London, whereas houses have trundled upwards. So even within the housing market we've had over the last few years, where a lot of people, the average house price index has gone up, we've had sort of economically driven and again, the underperformance in London was really to do with the Brexit vote, lack of new investment coming in, overvalued, just super unaffordable. You need 100 grand deposit to be able to buy. So we've got the examples, I suppose, and we're aware of them, of the examples where house prices have fallen for economic factors. And I think, we can't, the housing market is just an extension of the economy. So I don't know what you two guys think is going to happen to the economy. So it's all about, a lot of it's about what is going to happen to the economy, jobs and things.
Charlie.
Yes.
Yeah, I mean, listening to you there, Richard, I understand why you'd hold those views. But if I may,
go for it.
The amount of debt that we're in currently as a country, I mean, if you go back to 2007, we did have vast personal debt. I mean, a similar level to the amount we have now per capita. But we didn't have the public debt, which, we were running at just under 40% of our current public debt levels because of QE after that. So the government now needs more tax money to service its debts, just as they're increasing the taxes and the people are paying higher mortgage rates and therefore servicing even more debt. So as a population, we have less money at the same time that we have inflation. And people will talk about the labour market and say, well, there have been good pay rises. Those pay rises are below inflation. I'd like to, I mean, you've been doing this a very long time, so I'd like to understand your view on this. My theory is, looking at all the data going back to the Second World War that I could get my hands on, the primary driver for house prices is wages. And that is because you can borrow a multiple of your wage, and if real wages go up, people in the UK believe that houses are king, and they will just spend more on a house in order to get the house they want. That's the primary driver. The secondary driver is interest rates. So you can have a period like 95 to 2007 where we saw massive real growth in house prices. They tripled, basically, in real terms, not nominal, real terms, they tripled. But we had 5.5% average interest rates. So it wasn't higher than we have currently. And people are going, well, the interest rate now is killing us. Well, that's true. But we had a 36% wage growth. And that enabled us to service 5.5% Bank of England rate, mortgage rate. And also people had, up until 2007, far less debt. So you then have another possibility. As you know, in real terms, house prices actually didn't stop falling after 2008 until 2013 was the bottom in real terms. And then two things happened. One, Help to Buy. But the second one was, for the first time in all those years, real wages started to increase. But it didn't actually move the marker for many years until we also had 0.5% interest rates. So if you have very fast, high wage growth, no matter what the interest rate is, up to a point, 5.5%, let's say, you will get house price growth. Or if you haven't got wage growth, if you put interest rates down to 0.5%, you will still have growth. Not big, because in real terms, we didn't reach our 2007 peak until 2021. So, okay, what's the other way you can do it? Well, you can lock people down at home, not let them go on holidays, not let them go shopping in restaurants, let them build up vast savings, give them furlough money, and then also you will have house prices go up because people have more money. The bottom line is, the more money people have, they don't pay for homes based on what that home is actually intrinsically worth. They pay for it based on how much they can pay for it, based on how much money they have. Accepting that, first of all, would you accept that as a premise?
Carry on. I'll come back to you. Look, I agree with you that over the long run, house prices are simply a function of incomes and interest rates, basically. Yeah. Now, I've got slightly different numbers on. I've got this very boring, sad chart that sort of deconstructs every year of house price growth from the 1950s into what can you explain from interest rates, what can you explain from earnings growth, and then there's actually then what we call a residual element, which is like people just, exactly to your point, in the late 1980s, in the 2005-07, people just threw more money at housing to get more. The question is that what they're doing now? But finish your point, please.
So we have a vast amount of debt to service. The interest rate for servicing that debt is going up. Companies are not paying above inflation wage rises, so we have real wage decreases. The government will find it very hard to bring in another Help to Buy scheme or to print more in terms of quantitative easing, which, let's face it, didn't help the first time around because the banks didn't lend it, which is why the COVID money had such a big impact, because it was given directly to the individual rather than actually being given to the banks. And that's why the inflation is where it is. But in that scenario, you have a public who are going to be able to spend, they have less discretionary spending. Now, that is going to impact businesses, hospitality, retail. They won't be getting the money. And when they don't get the money, they will, of course, have already created the product. That's the way it works. So they will then be left with products they can't sell because their audience don't have the money to buy them. In that situation, companies tend to reduce the amount of pay they give people, or in fact, lay them off. If you look alongside that, the fact that we have almost 6 million people on universal credit at the moment, a number that is double what it was before COVID, and that number is increasing on a monthly basis due to long-term sick and also people who have jobs but are not earning enough to pay for their basic essentials. I don't see how we could be in any position where there is not a dramatic correction in the house price, which is at almost an almost all-time high back in September, October of last year.
Correct. Yes. So two things on this debt thing. I think we've got to separate out household debt used to buy housing, and then government debt and corporate debt, because they drive different things basically. So yes,
we have 1.6 trillion pounds worth of mortgage debt. We have 250 billion pounds worth of household credit debt. We have corporate debt, can't remember at the moment, I haven't got it in front of me. And the government debt is likewise vast. It's roughly £30,000 per head in this country.
No, I agree. Look, I think there are macroeconomic factors around the government debt, how sustainable it is, how much you have to put interest rates up, etc. So a lot depends on what your view of government debt is and interest rates going into the future. I mean, the housing market's worth 10 trillion. So, the LTV of the whole housing market's about 20%, basically.
But this is, you see, that's the thing that I find really interesting. People keep quoting either 8 trillion or 10 trillion, depending on how they're working the numbers. The value, in inverted commas, of the housing market is absolutely immaterial. You could say the housing market is worth 2 trillion or 20 trillion. It doesn't change the amount of debt and the interest rate against that debt that you have to pay.
I agree. And so two things on this around the household debt, and because again, I read a lot in the newspapers about people saying, well, and again, all the narrative in the last recent period has been, going from 2% to 4% mortgage rates was going to create a crash. They're going from 2% to 6% mortgage rates was going to create a crash. I think something that ever since 2015, you can't get a mortgage to buy a house unless you can prove to your bank you can afford a 6.5 or 7% stress rate.
That's not true. That's not true. The stress rate was only 3% above your confirmed rate.
SVR.
Okay.
It's 3% above the SVR basically. So again, I mean, I spend a lot of time chatting to mortgage lenders, they're clients of ours, etc. So, the Bank of England could see this problem brewing of cheap mortgage rates leading to a massive debt bubble amongst households who literally ran off and bought bigger and bigger homes.
Mm.
And so about 3 years ago, I did a presentation to a room full of folk, and I think I worked out at the time that house prices in London would have been 30% higher 3 years ago than they were if banks had just been allowed to lend on affordability with no affordability testing, basically. And the Bank of England brought this in. There were two things they brought in. Number one was you have to prove to your bank you can afford 3% above the reversion rate, which is the SVR, which again, I've got a chart I have to share with you. It's 6.5 to 7%. There were some rules that banks didn't have to do that test, whether the loan was more than 5 years, but they've got prudential regulators and other regulators all over them. So they've applied it to pretty much everyone. They did remove that in August last year. But the other thing they weren't allowed to do was do more than 10, 15% of their business at high loan to incomes. And so what these stress tests and these loan to income limits have done is it means that only 5% of new mortgage lending has been done at loan to values of more than 90% and at high loan to income. And so, and this, I think in previous downturns in 2005 to 2007, there were none of these regulations. Banks crept credit and they lent to people. And for me, the classic one was in 2007, a third of people taking a mortgage did not prove their income to their bank.
No,
and that's when people can just overpay for housing, and then prices can recorrect. And the same thing in the late 80s, but again, people just saw their homes as an investment, etc. So I think, but equally, even though we've had these stress tests, and people have rightly pushed back on me on this, which is the stress tests were there, but they weren't allowing for the fact that everyone's shopping bills and gas bills and electricity bills were going up. So there definitely are going to be people squeezed here. But I think I don't really accept the fact that cheap money of 1% and 2% mortgage rates has been fully priced into housing. It's to me as if the housing market's been operating at 6.5 to 7% mortgage rates for the last 7 or 8 years. So when rates go back up to 4, 5 and 5.5, people don't want to pay. It's of course the last thing you want to do is spend another 200 or 300 quid a month on top of all the other bills increases you've got. And we have to see how this plays through into arrears, etc. But again, when I chat to banks, I look at the data of the Bank of England, which is lagged by a quarter. Arrears are there, they're increasing by a small amount. But I think the trouble with all these mortgage regulations we introduced, it has excluded more and more people out of the housing market. It's made the housing market smaller. And so, and this is one of the challenges you have with the housing market, is the housing market's becoming more and more polarized. And I'm sure you've got a lot of frustrated folk on who sort of track you guys and listen to your conversation who feel excluded from the housing market because they can't get on, but they're paying their mortgage, but they can't prove to a bank they can afford. And so at the moment, all the banks are stressing people that sort of, even though the mortgage rates have gone up to 4.5%, 5%, 5.5%, you've got to prove to your bank you can afford 8.5%. And it's really excluding people out of the housing market. So the big hit for the housing market this year is volume, as we've got 20% fewer transactions happening. And so it's transactions in the initial term that tend to mask the hit from all this stuff. And then prices and the price falls follow thereafter, basically. So I think I buy your points on debt. And I think actually we haven't got a negative equity sort of downturn on our hands here. Again,
not for many. So, yeah. I mean, again, you talked about how divided, and this is the problem with talking about averages. And I agree on most of your points there, especially the 2007 debacle of Northern Rock with its 125% mortgages that they didn't even bother to check. But we are in a country where there are many who bought X years ago, either have no mortgage or a very small mortgage on their property, have pretty good income. But we also have many who are right on the edge and made themselves squeaky clean before the stress testing. And now they've got much higher bills elsewhere. They haven't seen much real wage growth, although they have seen quite large nominal raises recently with inflation, potentially. But as a country, our GDP, where we were going as a country, has stalled ever since 2000. We are not a productive nation, which doesn't bode well for our business. And again, you say it's not a negative equity situation. No, for many people, it's not. I mean, they may lose some value off their property, but they've got lots of equity. But for people who bought, especially using Help to Buy, especially in the last couple of years, especially young first-time buyers, they will be in the same position as people who bought in 88, 89, when Mirus was disappearing, and they thought, Christ, we better get in there fast, and they just pumped the price up.
Guys, sorry, I've been listening very carefully to both of you, and this is I think it's a really, really valuable conversation to have. But let me bring my perspective here. If we look at the population as a whole and its ability to buy houses, so we're not looking at the individual, the anecdotal market, but the population as a whole, we've got real wages falling. On that, we all agree. Yes. On top of the real wages falling, we've got the cost of living increases that are still, although the rate of increase is slowing, the actual cost of living increase continues. Mm-hmm. Right. So that's on top of falling real wages. So that's a double whammy. Number three, and this is before we even talk about job losses. Okay. Number three, we've got tax increases.
Yep.
Right. Everyone, as of April this year, paying more tax, and all of this is eating in to people's spendable money. Now, I think Alex, correct me if I'm wrong. The Bank of England figures today about a credit card debt record, or a very, very large number of increase.
Yes,
so credit card spending is shooting up, and if we weren't, if the war in Ukraine ended and nothing else bad happened, and all the economies and the employers that are there now were able to continue, hypothetically, then I think I would agree with your current projection, Richard, right? But what I don't think, and in fact you even said, you're not expecting the jobs market to get much worse. If we accept that a lot of very large employers have got a lot of debt and are now going to be unable to service that debt at the same time, because the interest rate, the cost of servicing it goes up for the corporations and for the government, number one. So, number two, the sales the sales volumes, right? Because one of the things I find amazing about RPI is that it's nominal. It measures that how much money people are spending, not how much they're buying. So you've got value and volume. And actually, the headline is, oh, the retail's gone up. No, people are buying less. It just costs more. So has it gone up or has it gone down? The headlines always say it goes up, but actually it's going down. People are buying less. So these big corporations with large debts are actually experiencing declining sales. The employment figures, if you dig into them, are not as good as they look. Vacancies are falling. Unemployment has started to increase slowly. The number of companies going into administration, not insolvency, but administration, has spiked and is going up. And anywhere you look for a completely objective, impartial leading indicator of what employment looks like for us is well, you start to put them together and it's nothing short of catastrophic. And this is where I think the major divergence in our views comes. Like myself and Alex and other people are looking at the economy and going, it's stuffed.
Yeah,
it's absolutely stuffed. And
that's the polite version.
Yes,
I think where we
and so so when so people are going to have less money. People are going to have less jobs if we're right, and if the economy picks up, then great. But there are already staggeringly large proportions of the country who are in unmanageable debt. Like 1 in 7. These are big numbers, and they are getting worse and sinking faster. And I think the spike in credit card debt is coming from people who've got no other way to pay their bills at the moment.
The question is, are they renters? Or are they, again, it's this point about, again, because the markets, you got people who own outright, you've got renters.
Why does that matter, Richard?
No, well, sorry, let me ask, are they renters? Yes, and all first-time buyers are renters too.
Well, they were renters, yes. And I think we're all broadly on the same page here. It's actually about we all agree that, I think I even put in the house price index going, this isn't a negative, even if house prices were to fall 10 or 15%, not very many people are going to be in negative equity. The banks are going to support them as long as they still remain in employment. The question really becomes one of just how much money have Brits got to pay towards housing of any tenure, whether it's mortgage payments, rent, other costs. And so it's this transition mechanism of what does all this mean for house prices? And my view is you get hardly any house price growth for quite some time to come. Whereas you guys are in the more aggressive camp of you get a big drop in prices over the next few years.
And then you get no growth.
Yeah.
and then you get.
We agree on the latter part.
It's all about it's all about just the angle of decline in the near term. So yes. It's and again, but I do think the mortgage market, given that we're there's a lot of focus on the transition mechanism, higher mortgage rates for the people that own with a mortgage, we've just lent to much better credit quality people on higher incomes. Of course, a proportion of them could be impacted if unemployment were to increase, et cetera, and they could have afforded to pay more. So I think if you get a really big economic downturn, the housing market is not immune and can't duck it, right? And so. Again, I tend to take, rightly or wrongly, what the consensus is amongst economists, basically, for economic growth.
Well, they've been wrong. They've been wrong for about a year. A consensus of economists has been wrong on interest rates and on inflation for quite some time. And I think it's interesting you say that, because last autumn, the consensus was inflation is going to come down really fast and interest rates won't go this high. And so those of us in the housing market were looking at that and going, oh, well, let's assume that they're correct and base our projections on that. They were wrong. Inflation, and just today, Andrew Bailey's gone, they're going to be high for longer than anyone really realized.
Yeah. And I think, thank God we've had this stress testing. So I think, my take is 4 to 4.5% mortgage rates are kind of okay. They're consistent with flat prices and 1 million sales a year, which isn't fantastic. But the higher they stay above 5%, and the more downward pressure that puts on prices, more likely to price falls. And to your point, Alex, I think, again, I look at this pretty closely. 5% of mortgages in the last 2 years have been over 90% loan to value and high loan to income. So let's hope those people have all taken 5-year fixes.
Yes,
and
that would be nice.
Because they're the ones. And I personally think the government should extend the mortgage indemnity guarantee scheme, because if they're on a 2-year deal and they're close to zero equity, then they're going to struggle to get cheap finance. So, and again, I think Help to Buy is a totally separate conversation. We shouldn't have extended Help to Buy. We shouldn't have done the 40% equity loan in London.
Shouldn't have done the stamp duty break in the middle of COVID. We shouldn't have done these things.
So I think it's but the government decided to do these things. So I think Help to Buy is, because again, my analysis on London Help to Buy is for a 600 grand flat in London with Help to Buy, you could have afforded to buy it with a 5% deposit and a 60,000, 80,000 pound household income. If you go quote unquote cold turkey and have to buy that home with no Help to Buy, a 10% deposit, you need to be on £120,000 income. So it just prices a whole slug of people out of the market, which is why, people who want to sell new, Help to Buy as they bought in the last 2 or 3 years are going to struggle, basically.
Home ownership has decreased by what, 8-9%?
Yeah.
Guys, let me cut in. We're getting on towards the hour mark, and we've got a few questions that I'd love to put to take from the audience who've been watching for a while. Where I've got here. Yeah, here's a question. It's about, Richard, apologies if it's actually not a question you can answer. If the Zoopla index is slow moving, does that mean its automatic valuation tool is slow drop days on price drops?
No, I think it's
based on their asking prices on it.
It's a different, the valuation tool takes a different index that's more dynamic, basically. So
okay, so it's not connected to your index.
Not really. It's a different. The automated valuation model takes the same kind of comparable inputs. It does have a more localized dynamic index that you wouldn't necessarily put on a chart, if I could describe it like that. So the house price index is just about broad trends.
Okay, so all right, and you can't speak about how that works, the sort of the individual property valuations.
It's again, that's subject to lots of testing. I mean, it does what a surveyor does. It looks at all the comparable evidence. It indexes forward historic values to today's date, and then there's an algorithm that tries to come up with the most accurate number. Look, if you're trying to value a 3-bed terrace where there's tons of liquidity, it's super accurate. If you're trying to value a 6-bed mill house in the middle of nowhere in Surrey, it's going to struggle, just like a surveyor's going to struggle or an estate agent's going to struggle.
Absolutely. Yeah. Okay. And I had, just going back to our conversation, I had a question, Richard, about. I mean, the way I see it, the Bank of England is not denying, and the market is pricing in, that the base rate will continue to climb a little bit to the end of this year or beginning of next year. And would you agree that house prices don't tend to see the full effect of interest rate changes for about a year, for a number of reasons? It's a very rough thing. I mean, the Times put out that graph a couple of days ago about the 5-year graph of number of mortgages. It gets up to 6 or 7 million mortgages reaching the end of their fix in the next 5 years. Who knows what rates are going to be 5 years from now? But yeah, the 1.4 million people coming to the end of their fix before the end of 2024 are going to be waking up to a whole new reality. Mm-hmm. So never mind what happens to the economy and jobs and recession in the future. We're still, and I'm asking you whether or not you agree with this, whether you think this is a factor. The time lag or the delay effect of interest rates actually feeding through to prices has yet to play out, or do you not think so?
No, it has. I mean, it's well, I think there's two things here, isn't there? There's the stress on what's left after paying bills and your mortgage for mortgagees who aren't planning on moving. So that's more of a sort of taking spending power out of the economy piece.
Yeah.
There's a question then of, as people move on to these higher rates, how many of those people will truly be forced to sell their property, putting more forced sellers into the sales market, which would then add to downward to more likelihood of prices falling. Again, like I chat to lenders, I chat to brokers. I think you and I have chatted, Charlie, on Twitter about this. If you're moving from 2% mortgage to 6% mortgage, by adding 5 years to your mortgage, you can get the same repayments. Now, the average remortgage has got 11 years left. That doesn't work if you've got 25 years or 30 years left, because you simply don't want to add another 5 years on. People just aren't going for it. People aren't going for it. They're finding the money from somewhere, and maybe they're taking out a savings, and they're hoping rates are going to be lower. So, and we've got about 15% of mortgage holders are going to remortgage onto a higher rate. So there's absolutely a squeeze coming on to a certain proportion. Rates are going to stay higher for longer. And again, we're in this transition from cheap money to sort of 4, 5, 6% mortgage rates. Again, I hope we don't stay at 5.5, 6, because I think that really is going to sort of mean bigger price falls than we expect, if I'm honest. I mean, I'm assuming kind of mortgage rates 5-year 75 LTV fixed rate mortgage is sort of in the 4.5 to sort of 5.25 zip code, I think is just about manageable. I think we get up into the 5.5, 5.75. I think you get bigger, I would be revising down. If I thought mortgage rates would stay at 5.75 to 6 for another 18 months, I'd probably be looking to revise down kind of what we're saying. Sorry, Alex.
If Bank of England rate is going to hit 6 to 6.25%, now it may
Yeah.
not, but even the Bank of England is suggesting that it will, and the market is suggesting now 6.5. Mortgages tend not to be less than the Bank of England rate in the short term.
For a 5-year fix, though, I mean, my assumption is people take a 5-year fixed rate mortgage, basically. So again, I'm only looking today at the big banks are all at 5.34, 5.4. And I think mortgage pricing is already priced in where the money markets think the Bank of England rate's going in the short term. So, and I think what's happened is the 1-year rate's gone up a lot, the 2-year rate's gone up a lot. So I think everyone's assuming inflation's coming down, therefore interest rates would come down. So ultimately, it's the swap rate that drives the 5-year fixed rate mortgage. And again, 9 in 10 mortgage holders have got more than 25% equity in their home. So 9 in 10 mortgagees remortgaging are going to be at that 75% LTV or lower, where banks see lower risk, etc. So there's definitely going to be a squeeze on some people. Some people are going to have to move on to interest only or extend terms, or they don't seem to be doing it just yet. And again, maybe it's to do with the higher credit quality people who've been borrowing. But if inflation keeps rolling, and again, if what you guys are saying, if you get really bearish on the economic outlook, then you have to take a more bearish view on house prices than I and others are sort of taking.
Yeah, because the thing is, for all of those mortgage holders who come to the end of the fix and absorb that increase, which is what most of them will do, that money's being taken directly out of the local economy.
It's like the money markets have moved ahead of the Bank of England just to suck a load of money out of the economy, basically. And again, I was listening to a phone in recently. We got half of all homeowners have no mortgage. Probably a lot of them are retired. There's one gentleman on a phone in said, "I've just had a 13% pay rise on my triple lock." So, it's trying to and again, renters are having a tough time. Mortgage holders are starting to have a tough time. And I think, we do have a lot of people who don't have a mortgage and or are retired. And again, it's sort of, as someone else on our Twitter world said, maybe, we should be pulling the tax lever. But again, I don't want to go there. But, because what we're all trying to do here is to work out how do all these different factors impact on people's pressure to sell and how much can they afford to buy. But I totally agree with you both that anyone buying a home now and into 2024, their buying power is down 20% basically, but I don't think it goes straight through to house prices.
Okay.
But I equally, I think you guys are probably far more bearish on the economy than I am. So that explains.
I think that's where our difference lies, isn't it?
Yes. Yeah.
We're very, very much more bearish on the economy. And again, I mean, for different reasons. I mean, Alex comes at it from a very much macro data point of view. I'm looking at it as a finger on the pulse, and you see the local. And they're entirely anecdotal, but I mean, I'm between London and Devon, and I travel around a lot, and I just see it's sudden noticeable changes in how busy the restaurants are, in how busy the roads are, just things like that. Bookings of this, bookings of that, and it's just and then you see these reports from. To me, the strongest indicator of trouble is the insolvency industry saying record numbers of companies going into administration, which is not in official figures yet.
Yeah. And I think, look, it's, I forgot what I was going to say now. I think it's, and the other thing I would say, which I think is, I would be more bearish if I truly believed that super cheap mortgage rates had been fully priced into house prices, because then you would have a much bigger reduction in house prices. And I think, again, Bank of England gets very little credit for anything at the moment, but I think the one thing it did do, it had learned from the global financial crisis of people just becoming inundated, just taking on way too much debt than they could sustain.
Yeah.
And again, I remember 3 or 4 years ago, people in the housing industry going, this stress testing is ridiculous. It's pricing lots of people out. It's draconian. I think Andrew Bailey was being panned at various Treasury select committees about it. But, with hindsight now, A, thank God we had it, but B, did it go far enough is what people are rightly saying, because of the squeeze on household incomes, because of the £5 Lurpak packs of butter and things. And so It's going to be tricky, but I think, for me, housing markets in the south of England, from Norfolk down to the southwest, anywhere with a house price over 400,000, 350,000 is where the biggest, this hit of higher financing costs is going to hit hardest. I honestly don't think parts of some of the north of England is going to go into negative year on year, but I do think the south of England kind of will. But there's more equity to absorb the fall.
It's the Midlands. It's the Midlands down, isn't it? I mean, but then you could argue that most areas in the north didn't really recover from 2008.
No, I agree. Look, and there's parts of the northeast where house prices are only 10% higher than they were in 2007. I mean,
Exactly.
Sunderland is now falling, but it's a super weak economy with hardly any sort of economic growth and job creation, and so the housing market, a bit like Aberdeen, is sort of reflecting it. So anyway, we can get into local. I know we've been panned for talking so much London, but there's a lot of different trends out there.
So, okay, Richard, let me ask you to elaborate on the thing you've mentioned a few times, which is what you see happening to house prices further out, 5 to 10 years out.
I think I haven't officially got a view on this, but I think I think we're going to see what we've seen in London flats. I just think we've got this huge hit to buying power. You've got all the generations getting, there's these great charts of how every generation's getting less well off than the one before.
Mm-hmm.
Mortgage rates can't go any lower. They've gone up, and now let's assume they're going to stay at 4 to 5% for the next 5 or 6 years. The best house prices can do is rise in line with earnings or incomes, basically, which might be like 1% above inflation. But actually, I think they're going to underperform inflation and earnings for the next 3 to 5 years. So I really think, but I think all we're disagreeing on is you guys think it's a down 20 and then go sideways. I'm more like down 5, 6, 7, and then it goes sideways. So
yeah, we agree. I mean, your projections there are absolutely simpatico with what Charlie and I have discussed previously. My view is that around 2030, when central bank digital currencies are likely to make an entry on the stage, we may then find another mechanism that will change things. But certainly the next 5 to 7 years are going to be very uncomfortable, and certainly not a champagne and partying time.
No, not at all. I think the other thing I'd say is, again, I think then you get into, again, you got all the energy regulations coming through. So I think people are going to get way more focused on how much money do I, if your house isn't going to go up in value a lot. So the average homeowner stays in their home 20 years, first time buyers maybe 5 to 12. People are going to get far more focused on how much money am I going to have to spend on this house? Because I think a lot of us who've owned homes for many years, we spend a lot of money on it, go, we'll get it back when we sell it. Well, what if you now don't? So people are going to get much more focused on how much money they've got to spend. They want that off the price day one, so they negotiate harder. Then you start adding in all the EPC requirements. At some point, we're going to have a minimum energy standard in this country where you can't buy or sell or rent a house unless it's an EPCC. So anything that isn't an EPCC needs that money spending on it. That's going to come off the price. So I just see a lot of sort of lead weights, frankly, attached to house prices looking into the future. So again, which is why I'm more of a sort of low to no growth rather than the collapse. But I think over time it sort of has quite a big impact. So maybe look, I think a lot of people in industry are V, because again, all estate agents, house builders, lenders want is volume, basically. I think consumers care about pricing because it impacts your ability to buy, the value of as a homeowner you get for your home today unlocks tomorrow's move. But actually, industry wants on volume. So I'm a bit more optimistic about volume. I still think we're going to be at 1 to 1.2 million sales a year. We've got a massive demographic bubble of over 75s coming through, all equity rich. And again, how many of those people think their home's a liability more than asset? And they want to downtrade and they want to sell, and there's nothing to downtrade to. So I think there's some really interesting trends coming where, but I agree with you that the sort of house prices only ever going up thing is not going to be the reality in the next 5 to 7 years.
It's refreshing to hear you say that, Richard.
Yeah.
Because I know there are a lot of estate agents watching who just always go, house prices always go up. They always go up. So for you
but if you buy a super energy efficient house in the right area that's cheap to retrofit and got low running costs, I think what you're going to find is across the 30 million homes in this country, over the next 10 years, there's going to be ones that actually do pretty well. But you've got to start thinking about not just location, but running costs, retrofit costs. And again, I think you're seeing it to some degree. I mean, we do a lot of work in the equity release market, and someone's been in their house 40 years, hasn't spent a lot of money on it, they want to just release some equity and down trade. I mean, those homes are, they're poorer condition homes, so they get sold for sort of 10 to 15% less than what a good home would be. So I just think anyone buying property, you've got to be far more. I mean, every asset now is going to have its own value, basically.
I was talking recently to some people who work in equity release on the legal side, and they're saying that the lenders on equity release are massively reducing the amount they're lending.
Yeah,
they're worried. Now, there's quite a few people saying, and this is a question actually I need to put to you, Richard, and then I think we should wrap it up. So what's the consensus then? Now, you talked about the end of 2023. Could we ask you for an unofficial, nominal guess for where house prices will be at the end of 2025, which is roughly when I think they'll hit the bottom?
I really don't think they'll be less. I don't think they'll be less than 10% nominal where they are today.
Okay, all right.
Which would be on real terms, they're going to be down 22% on that basis. Because I think, again, the economist consensus over the next 3 years for inflation is 12. So if I say up to 10, it's going to be up to about 22% down in real.
Yep.
All right.
You're getting close to my 30 to 40%.
Where are you? So your Alex is what real?
30 to 40% real.
And Charlie's 35% nominal.
Yeah.
Very good.
And I want to be very clear. I've said with a regional variation of minus 15% nominal to minus 50% nominal in the most affected areas. And I'm saying this because my number one mission is to try to prevent as many people as possible from falling into the negative equity trap. If they can keep on paying and come out the other side eventually, cool. But if they need to move and they can't, that's a horrible way of your life's plans being curtailed. But worst case scenario, if you end up having a home repossessed in negative equity, that's a life changer. It's just awful. So I want people to just consider negative equity. And that's why those are my numbers. And by the way, I still, precisely because of how bearish I am on the economy, and whenever I get people challenge me on that, I say, well, tell me why. Why are you not bearish on it? I haven't heard a single reasoned argument as to why they're not bearish on the economy yet. Because of my bearishness on the economy, that's where I see it going. 35% on average across the UK. Whenever the bottom might be 26, not 25. I don't know, but it's roughly 3 years. Again, give or take the 9 months that the Land Registry takes to report on this stuff. And I'm really happy to have learnt to hear from you firsthand what the Zoopla House Price Index intends to represent, because we can then compare that with the Land Registry figures 9 months, and as I'm sure you must do, and see how that's going. But thank you, Richard. Really, really grateful for you coming on this evening's show. Have you anything you want to ask me, or anything you'd like to say?
No, look, it's been a good discussion. I think if you put stuff out there into the market, then it's always good to get challenged. So as you can tell, I'm very happy to come along and give you my thoughts. But I just, my view has always been, ideally I want to be right. But I think I hear you on the sort of confirmation bias stuff. I think but as I said to you earlier, Charlie, I think the government, there's a whole vested interest against prices falling, isn't there? There's government,
yes.
There's banks, there's industry.
Yes.
And again, I think
everybody wants to prop it up, no doubt.
Lenders.
But I think the question, and again, I think, but how the lending industry approaches forbearance or not, what the government does have a big impact on this stuff. So I'm afraid we're not in 100% market forces only here, basically.
No, there's interference.
There's some work around the edges. So again, but it might just, because what we're all talking about here is when do sort of house prices and incomes get to a level where more people, the market can operate in a kind of more normal way and prices established to a decent level of turnover, basically. But thanks for the invite. It's good as ever. I think we haven't quite convinced most of your audience, but I've won a few over, I think. But that wasn't the intention of the evening, but it's good conversation.
Thank you, Richard. It was great. It was great to talk with you.
The one thing we all agree on is that liquidity is good for everybody.
Exactly.
Liquidity is good. So more transactions is good for everybody. Guys, thank you so much, Richard. Really appreciate it. Thank you, everybody, for watching. I hope you found that useful and interesting. Alex, thank you as ever as well. Have a great night, guys. Tomorrow's 5 Fact Friday, always, which I'll be, No idea that's going to be yet. I'll figure that out tomorrow. Have a great time and see you on the next video.